All right, so welcome everybody. Thanks for joining us today here in March of 2022. As you can see from our table, we have baseball back. The billionaires and the millionaires are done fighting over pennies.
That's right.
Right? Frustrated all of us, but I'm glad they're back. I'm glad hopefully to see the Blues make a long run in the playoff. Time will tell. So today, gentlemen, let's hit the topic of the day, our dear friend volatility. We talked about volatility a little bit last month or the month before. It's continued. So I thought today we could dive in a little deeper, share a little dialogue and a little perspective with our friends and maybe help them get their arms around what seems to be a daily up and down of the market. Fair enough? Mm-hmm. Initial thoughts on volatility, Jay?
You know, there's a lot of volatility right now, but it's really caused by one person in particular.
Who might that be?
Mr. Putin. What are you doing, sir?
I thought he's causing all the world's problems.
At the moment, it seems like that, yeah.
Cody, what do you think?
Volatility, it's just a standard in the market. You know, it ebbs and flows, and this isn't really any, what I would say, uncommon circumstance happening right now.
Yeah, and I would agree. And maybe we can break it up into a framework of yesterday, today, and tomorrow in terms of trying to provide some perspective on volatility. And I'll start with yesterday. If we look back, some very interesting data when we study volatility. And I think the one that jumps out to me most, if you look back the last 42 years, on average, it was shocking to me, 5 times per year, the market's been off 5% or more. Those are pretty significant numbers on average. 5 times a year, the market's been off 5% or more using the S&P 500 as a benchmark. And that tells me that volatility is very much part of the equation. We haven't had it for a few years. It feels a little creepy. But if you look back 42 years and you have that kind of data, it's part of the equation, right? So really with that as a perspective on yesterday, Jay, talk to me a little bit about your thoughts on today.
Yeah, so hopefully, because like you said, volatility is just part of the equation, hopefully we have some sort of plan of what to happen or what we should be doing or thinking about when there is volatility, right? And so that's something we're always talking with our clients about in the good times because we know that there's going to be craziness at some point, right? And so when it happens, we really want to stick to that plan that we had set out. Try not to deviate from it too much. That's the best plan, right? Don't panic because investing can be really emotional. We're talking about money. We're talking about big sums of money. We're talking about life savings. It can be super emotional. And so if you look at this number here, if you see the orange bar on there at 2.9%, that's the average investor, in which case, what are they going to be using? Probably not checking in with somebody. Instead, they're trying to guess and try and time the market or react or whatever. So we don't want to be over there in orange. We'd rather be over on the green, blue, and dark blue. Not purple, I was corrected. Colorblind Jay, I thought that was purple. We'd rather be over there. So, you know, if you just put everything in stock, probably not a real comfortable ride. But if you're not trying to change and make a whole bunch of changes when something happens, we'd much rather see people in diversified stocks, bonds, some sort of allocation that we're sticking with. So you can see 60-40, 6.4% return over the last, what is this one? Is this one 20 years?
20 years,
yeah.
So, you know, what's happened over the last 20 years? Have we had any volatility?
Oh, my gosh.
Let's see. Let's start going backwards. We've had Ukraine recently. We had COVID in there. We've had taper tantrum. We've had the 07-08 crisis. We've had, if we go 20 years, that's the tail end of the dot-com bubble.
Right.
So we've had all kinds of different examples of volatility.
All sorts of stuff.
Tons of stuff. And yet you can still see an allocation can give us a pretty predictable, let's call it roughly 6%, with a lot less roller coaster ride. So that's kind of the biggest takeaway today is have a plan. Let's stick to it. Check in with your advisor. Check in with everybody around you because it's crazy, but buckle a seatbelt and just let's hang on.
Absolutely. Yeah, and I think, Jay, what I would offer to that is that our strategy, our approach in terms of highly diversified portfolios, it's really for times like this. I mean, when the market's on a rocket ship up, any strategy will make you money. Let's be truthful.
Right.
Virtually any. Keep my friends at compliance happy. But a highly diversified portfolio is there for when we get these times of volatility that certainly aren't predictable and certainly feel creepy, right?
Right.
So really great perspective for today. Cody, why don't we now say tomorrow? What are we looking for tomorrow? How are we prepared for this to go forward?
Yeah, Mark, going back on what you and Jay had said, it's funny how people quickly forget what's happened, right? There's been some big headline news that has gone by, and everything seems to be just fine. But the chart I want to focus on is okay. So are we getting rewarded for the amount of risk we're taking? And we really like this one because it shows, the first one is an asset allocation, and then it goes and shows S&P 500, emerging markets, Russell 2000, so different types of markets. What I find interesting is that if you have a strategy put in place, and you're in different types of equities, domestic and international, and you're in different types of bonds, that it really does smooth out your investment experience. And that number is easily shown by something we call the Sharpe ratio. And we won't go in too much detail, but basically all you need to know, for every increment of risk you're going to take, what are you getting rewarded? If that number is above 1, that's always good. That means you're getting over-rewarded for the amount of risk that's being taken. And what it really comes in important to is when we start comparing it against other portfolios or other markets. And you can see that volatility and return is what makes up the Sharpe ratio. And 0.65 is higher than any of the other numbers that you're compared to, even though, a lot of these are 100% equity type portfolios. So, what that means is that diversification does work. And if you have a strategy in place, it helps keep the emotions out of it.
100%. And what I would say to both of you, I think all three data points tell us that trying to respond to volatility, that's going to be a loser's game.
Right.
You're going to cost yourself money and cost yourself return. And if you respond to maybe broader economic factors or equally important, you have a goals-based objective for the segments of your portfolio and you manage to that, this data just tells us that historically you'll be rewarded for taking that approach and not a panic reaction to volatility. Right. So, Jay, final thoughts?
Yeah, don't think that during times of high volatility, not making those reaction movements you're talking about is not doing something. You are doing something by sticking to your plan you already thought through. So hang in there.
Cody?
Yeah, biggest takeaway is having a strategy put in place. If you're emotionally respond to something or you don't like volatility and you're going to go in and out, you're going to get average investor returns, which, our goal is to get you above that. So I think keep the strategy in place, even though sometimes it's hard to stomach.
Super. Well, thanks to both of you. Thanks everyone for listening. And I would offer that if you have any additional concerns about your portfolio, you have friends, family that are feeling a little creepy with the volatility, share the podcast with them, have them call us. You have the number, shoot us an email, use the text line, and let's go Cardinals and let's go Blues. See you next month.